This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the Premier Trade FOREX Report with Scott Norse.
Good afternoon, traders. Scott Norse here for your FOREX Report. Today is Friday, May 9th, 2008. Dollar bulls got a dose of reality this week as a number of the currency's counterparts fought back. After reaching a new all-time low just more than 2 weeks ago, the greenback found a strong net and began to climb. However, the logic behind the net is not so strong. After all, most fundamentals still point toward a grim 2008 and possibly 2009 for the U.S. economy. The real story lies outside the U.S., where other G7 economies are showing signs of stress amid a huge commodities boom driving prices up for businesses and consumers. Meanwhile, the central banks who set monetary policy in these countries are keeping rates at or near multi-year highs to fight the inflationary pressures from commodities and wage increases. With borrowing costs high, growth ultimately suffers. Again, this is not necessarily a dollar positive, but more so a counterpart negative. And with the greenback seemingly having nowhere to go but up from record lows, short interest in the dollar falls and the currency temporarily rises. When we say counterparty negative, we're referencing economic reports from other major economies. With the exception of a couple, most have shown a turning point toward lackluster growth. From Eurozone retail sales and UK housing to New Zealand employment. However, the trends are not yet bearish enough in most cases to expect major long-term corrections in currency pairs. Even this week, the ECB said its primary concern remains inflation, which helped the euro find its footing. Therefore, we must pay close attention to any sudden change in sentiment as the markets are fragile. What traders panic about one day, they may shrug off the next. Now to the big picture. So now that the dollar has found a little relief, where do we stand? We believe the small rally we have seen thus far in the dollar still has legs. However, as we warned last week, the buck's rebound will not be a straight shot to the moon. Furthermore, some currencies will put up much better fights than others. For example, with stocks falling as we believe they would and will continue to do so in coming weeks and months, the yen and Swiss franc will be especially resilient. Conversely, when stocks surge big, we expect days of weakness from these low yielders. The opposite holds true for currencies like the pound and Kiwi. The New Zealand US dollar and pound US dollar pairs look particularly weak despite having high underlying interest rates. Both pairs are down sharply this week, so be careful not to sell short into weakness right out of the gates. Waiting to sell from resistance will undoubtedly serve you better. These two may find some relief when risk appetite is high, but in general, we do not like either of them long right now. The euro and Aussie will be mixed on the daily charts, but the weeklies are still very bullish in the big picture. We are open to taking these two currencies long or short against the dollar for now, but still see a max hold time of a few days in either direction. Wrapping up with dollar CAD, we are still hands off. The pair is in a 2-month sideways range and offers little in the way of strong technical signals. Till next week, have a wonderful weekend. Take care.